Hey everyone, in this video I'm going to answer which one is the better growth stock to buy, Peloton versus DocuSign. I'm going to look at each of these two companies' latest quarterly results. I'm also going to look at a little bit longer term their operating profit margin. Finally, I'm going to look at their valuation, compare which stock is more expensive in order to make my decision which growth stock is the better one to buy. So let's get started looking at Peloton's latest quarterly results, where revenue decreased by 22% to 750 million, although the net loss did improve to 276 million. That was up from a $757 million loss in the third quarter last year. Remember, Peloton absolutely thrived during the pandemic. Sales exploded. People had to wait 10 weeks to get the exercise equipment they ordered from Peloton. However, management overreacted to those positive results, invested massively in expansion, and then when economies reopened, sales declined and they realized they made a mistake over investing. And so the previous CEO resigned, new management came in, and the new management team has done an excellent job trying to correct for the overinvestment. Now, looking at DocuSign, it too thrived during the pandemic, right? People were not interested in meeting together to sign documents. Electronic signatures became incredibly popular. DocuSign thrived as a result, but the big difference between DocuSign and Peloton is that DocuSign didn't overreact to the positive news. They didn't overexpand, overinvest, and so now that economies reopened and demand for its electronic signatures have moderated, the company's not in a terrible position. In its most recent quarter, revenue increased by 12% to 661 million, and earnings per share improved to $0.00 compared to a loss of 14 cents in the same quarter last year. And management is expecting a rebound, a reacceleration in growth in the third and fourth quarter of this year. Looking back longer term, comparing these two companies on their operating profit margins, we could see that Peloton absolutely exploded in 2020. Its operating profit margin turned positive. However, as a result of the overinvestments, its profitability collapsed, and it's improving slightly, but it's still negative 41.4%. Meanwhile, DocuSign, the pandemic helped DocuSign thrive, but it's continued the momentum, it's maintained and sustained the momentum from the pandemic, and it's continued increasing its operating profit margin. It's almost to a positive level. It was negative 2.37% in its most recent quarter. I wouldn't be in its most recent trailing 12-month period, I should say, and I wouldn't be surprised if 2 or 3 quarters from now this turns positive. This turns positive. So finally, let's compare these two stocks on valuation, and I chose to use the forward price to sales ratio. And looking at this metric, DocuSign is significantly more expensive than Peloton. DocuSign stock is almost 4 times more expensive than Peloton stock, trading at a forward PE of 3.97. Forward price to sales, I should say, of 3.97 compared to the forward price to sales of 1 of Peloton stock. That said, I would be willing to pay the premium for DocuSign stock. I think DocuSign stock is that much better than Peloton that I would be willing to pay nearly 4 times the price to sales compared to Peloton in order to own DocuSign stock instead. All right, so that would be my choice. DocuSign would be the better growth stock to buy between these two right now. All right, but that's all I've got for this video. Thank you so much for watching. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.